The last time those things happened were in the 1930s. And if you look at history going back over periods of time before that, hundreds of years, I made a point of studying the last 500 years. If people are interested, it's on LinkedIn. It's called The Changing World Order.
Let me ask you specifically about this market disruption, the sharp increase in prices for some of these stocks. Do you have any concerns about the structural soundness of our financial markets? Did you see anything this week that would give you concerns about liquidity, about underlying vulnerabilities that would make us think back to 2008, 2009, the kind of structural problems we saw then?
No, liquidity problems, come and go, and then there's the mechanics. There's a certain speed of trading. There's certain algorithms that have trading that have these effects and can create dislocations. They've been with us, and they exist, but it's part of an evolutionary system in which you find problems and then you rectify them and deal with them. What I'm really concerned about is that 2008 represented what we have as a worse situation than 2008 now regarding the finances. So if you look at history and repeat over periods of time, there is the creation of money and debt to get buying power, but that is being produced by central banks that print that money because they can't finance the debt any other way. And that particular dynamic and the extension of it, which is repeated out in time, that if you like, I'll explain a little bit more of, that is the big concern. So there's a lot of money sloshing around, but if you think about it, the wave of financial assets, and we talk bonds and debt as alike, is believed to be, it gives buying power, but it's also believed to be that one could sell one's bonds and assets and buy goods and services with that, but the amount that exists out there that are claims is far greater than would be allowed to happen. So there's a financial situation which is deeply of concern to me. And to some extent, it provides the liquidity for some of these things to happen. But the things that are happening here, other than being reflective of the liquidity, are really just part of this bigger problem, I think.
We have, Ray, a current debate over what could be the next chapter in your story. But it's a complicated debate. Let me summarize it. The new Biden administration is on Capitol Hill urging a big stimulus package totaling $1.9 trillion on the argument that with interest rates as low as they are, with the country needing to rebound from the pandemic and lockdown, with the need for stimulative spending and investment, this is the time to go ahead and do that, even though it's an enormous amount of money and debt to be taking on. What's your response to that argument, which I'm sure you hear every day, as we all do?
It's not. There's not enough financial resources and money to go around. And so I understand the needs for that kind of spending and the actions that have been taken so far in terms of that kind of stimulus. But it is a mistake to believe that the lower interest rates and the debt service payments are the only consideration, because all those bonds, the debt is converted into a bond and has to be sold. And it has to be sold to buyers who then finds it attractive enough to own it. These interest rates are minus 1% in inflation-adjusted terms, and about 1%, a little over, in actual terms. And they build a pile of those debts that the bondholders believe they can turn into buying power by selling the bonds and making that purchase. I don't mean to sound technical, but what I mean is that when you have a lot of claims of assets, they're not providing a good return. And you have the world own too many of them. It's not probably going to be able to be bought by those. That means that they will have to, the Federal Reserve will have to make up a gap, a funding gap. The upshot of this is it is in cycles. This has happened throughout history. You can go back thousands of years and you see the pattern. And that pattern is not a pattern of good finance. It risks the dollar. It risks that the possibility that won't be a good storehold of wealth, those bonds. And that's not good, sound finances. So one should not delude oneself into believing that because interest rates are low, that's not a problem. I think it'll be a problem. I think one of the most important things to consider too is that money that's going to be expended also going to be productive in terms of producing goods and services and so on in its way. I don't think we're paying enough attention to productivity either. So I'm just a mechanic looking at how the machine works. And my definition of the machine is that it's very concerning.
Your point that we need to look at precisely how this enormous amount of money is going to be spent and whether it will be spent productively to really stimulate growth is an important one. I want to just pause a minute and ask you to share your thoughts about Janet Yellen, our new Treasury Secretary. Janet Yellen has deep experience as a central banker. She's got an extraordinary resume, but not everything she has done as a central banker, I would guess you would endorse. What's your evaluation of her? And if you could share what you're hearing from friends in the financial markets on Wall Street, what does Wall Street think of her?
Well, I think, as you say, I think she's skilled, experienced, has a broad perspective, and also understands the social issues and the political issues well. I do think that she might overemphasize the business cycle part of it. In other words, when she tightened monetary policy, I think she was thinking that the traditional economy would have a higher level of inflation, and then there was a readjustment in that thinking, which was appropriate. I worry that about the understanding of total balance of payments position. I think the United States has gotten used to being the world's reserve currency, which meant that they think that whatever we can sell the rest of the world will buy, and we're not subject to constraints or that dynamic. So that concerns me a bit. But I think you have, all things considered, a capable and open-minded person who is in a very difficult situation. I think sometimes we think that if we get a good leader, President of the United States or Treasury Secretary or so on, that they can deal with the issues and bring about good results. There are sometimes circumstances that they find themselves in, which the United States is largely in, which is it spends more than it earns, and it finances it with debt by a lot, and it has to sell those bonds, and there are no easy answers to that. And so the position that she's in and the are very difficult circumstances. So when one goes through the mechanics, you could have a very good person in the job, and that doesn't necessarily lead to great results, because the circumstances of the maneuverability is different. And so I give that example. They had to they had to send the checks. If they didn't send the checks, let's look back. If they didn't send those checks, and the Federal Reserve did not provide the support, we would have had a rebellion. We would have had people who needed the money not get it. You have a class warfare issue, and you would have had companies fail. So they had to do that. But as that circumstances meant that they had to produce debt and they had to produce money, so there's a mechanics to that. Now, that set of circumstances will exist, and they will, and the world, Republicans and Democrats, will debate 500 billion here or there or something, but the big picture is that situation is ahead of us, and it's politically challenging. It's, so we bring in the politics. As I say, there are three big things. We're talking about the finances. There are three big factors, and then we throw in the virus. The three big factors are this financial dynamic that we're talking about. The second is the polarity that exists in wealth, values, and politics, which is extreme. The class warfare, the actual willingness and eagerness almost to inflict harm on the other side, and the absence of reasonableness is at its greatest extreme. I looked at statistics, and I go back, and you would have to go back to 1900 to find something like this. And then we have the rising of a great power, China, to challenge an existing great power. Those three factors, the financial factor, the wealth gap and political factor, and the rise of a great power, the last time those things happened were in the 1930s. And if you look at history going back over periods of time before that, hundreds of years, I made a point of studying the last 500 years. If people are interested, it's on LinkedIn. It's called The Changing World Order. You could see these patterns in history. Those are the circumstances that we're facing. And so the issue really, I think, is can we face those things in a skillful way and a bipartisan way so that we don't do ourselves even more harm than the circumstances have brought us as a challenge.